All right, good evening, guys. Ken at Tortoise Capital. This is the small group coaching cohort 2, uh, June 11th, 2024. I should have asked if there was anything we needed to cover offline before we hit the recording, but if not, let's go.
I'll jump in and go first here,
Okay.
like I do, I guess. I won't be a ball hog though. Um, I'm sharing my screen here, and Kevin, for your benefit, I'm showing you our local hockey team, the Jacksonville Lizard Kings, and
Nice.
our arch rival, the Orlando Solar
The
Bears.
Solar Bears. I have watched them. I have been in their arena.
Hockey
Yeah,
in
I'm
Florida is
thinking the
just
same
wrong.
guy
Seriously.
did both logos here. Same
Nice.
PR company. Must be and I thought it
That's
was
funny.
funny that the Canucks only had two Canadians on their team this year and eight
Oh,
Americans and a bunch of
yeah.
Russians and Swedes and everything else. So
Well,
um,
the Olympic team. They're really struggling to find goalies because there's only one Canadian goalie.
wow. Yeah,
Um,
it's amazing how Eastern Europe makes those goalies.
yeah,
And
yeah.
here's a quick observation. You know, CalPERS is putting up a fight for Elon Musk's pay package, which is no salary and 100% incentive based. And they actually questioned Warren Buffett's management style a few months back. And at that point, I grabbed a picture of Warren Buffett's Berkshire Hathaway's headquarters, which has been their headquarters for 40 years. And then just for comparison, I jumped over and took a picture of CalPERS headquarters, which they just had built. So, and they're questioning Buffett's frugality, I guess, spending habits, and Elon Musk. So, just saying there. Um, but getting a little bit serious here, one of my goals for this course was to organize Joe's chaos. And part of that has been trying to get myself to trading a few symbols, trying to do EWW, but I seem to be getting distracted at 9:30 in the morning, which seems to be pretty crucial with that. But I'm getting there on EWW, DIA, and SPY. But one project I've been working on is to look at some of the other activities that I've been doing and try to put some rule sets around those. So one that I'm going to show you guys is sort of a position or swing trading process, and the other is a short term process. Both of which have been working for me, and I've never really kind of put a rule set around them. So um, this is sort of and this too is something that I'll feed into that Ruzuku mess that I kind of am building over there and putting
Yeah.
ideas together. But the idea of that seems to be evolving there is to come up with something that might take neophytes and feed them into Phil and Griff that would ultimately feed them into you as potential trading partners.
Mhm.
So this is just looking at a big picture investment discipline, starting with preservation, trying to create income out of that, and whether that's dividend income or skimming profits off of positions, and then growth is the third thing, and everything is surrounded by an exit strategy. What I call the missing link in financial advice in the industry. It's always buy more because it's down, or buy this because that's not working. It's never just go to cash and get out. So what
Well,
I
I
do,
also think I don't, I might think of that also as continuity and inertia and, feeding into estate planning, the longer term momentum, and robustness, less of a exit strategy and more of like a the perpetual motion machine, the legendary perpetual motion machine. Something that gives the idea of multi-generational wealth, tax planning, estate planning, transition planning, similar to what you're talking about in the email on that contract with yourself
Yes.
approach.
And
Where-
brief update on that. I did have a good conversation with Jim Stovall the other day.
Yeah.
And I don't know if you know who he is, but pretty spectacular guy. He wrote a book called The Ultimate Gift that was turned into a movie with James Garner and Brian Dennehy. And he had 7 more books that were turned into movies. But that book is essentially an estate planning kind of a idea generator. And my idea is a video or audio interview with ourselves or our parents when they are still young and spry, 50s or 60s,
Yeah.
and say, what are the metrics that would have you given up your keys, Dad? Or who do you know that should give up their keys? And then you have something in your archives that's in with your estate planning documents to bring out to them when they're 85 and resisting change, and saying, we're going to have video night, Dad. And you pop it in and look, it's you saying, when you hit the neighbor's mailbox, you're going to give up your driver's license. And Jim loved the idea, and he's trying to connect me with the American Association of Estate Planning Attorneys to try to get some buy-in from them on the theory that if they help create it, they will be much more likely to adopt it.
Yeah, and that's where I also think the, adding it, home savings accounts, the multi-generational dwellings on the homestead, assisted living, estate plan, that whole, it connects in a deep way to F. Buckminster Fuller's spaceship Earth idea. We're the arc, and this thing is continuing on this, eons long journey through space, and we got to do something as the caretakers, the shepherds, the care providers, the care receivers, and the cycles, phases of life. How we regain connection to across the generations and sort of respect the fullness of life. To me, that's more consistent than I think the words exit strategy, because it's really, because you're not getting out of the family car. You're just moving to grandpa's seat where you could enjoy, looking out the window and while Junior drives, it's his turn in the, you know what I mean?
Yeah, and one reason I have this around everything is because there are times when core positions just need to be unloaded. And I don't think at any phase along the way should we be without a rule set that says, hey, we're going to wait this out for a couple of months.
I think if you
let the
said,
bombs
maybe
fly
think of
or
the word,
whatever.
think of the verb transition rather
Okay.
than exit, because that has the sense of, I'm just morphing into another phase, as opposed to the, we're no longer going to be thinking about preservation, income, and growth. Well, yeah, we are. The estate is, but it's just my role in that on the board of directors there. It's in a different, I'm in a different seat on that now.
Sure enough.
In some ways, if you think of the Chinese tradition of the ancestors and the ancestral shrine, you know, there's always that place of honor where, you know, the icons or the pictures and the artifacts of each subsequent generation goes, and then whoever is head of household, you know, goes and pays respects there. And so we're not exiting the family, we're just no longer actively in the driver's seat. And that's why, to me, I think a consistent framing of that is transitions.
Okay, I like
I
that.
think, and that makes it easier for grandpa, me and you to handle that moment. You know, hey, we're not exiting the family. We're not leaving the reservation. We're just moving to the place of honor where other people are going to handle details, but still consistent with the timeless values. Something like that.
Sounds good.
That was the implication I was getting.
Okay. And drilling down a little bit on a sort of generalized investment selection process.
Yeah.
Um, you know, this gets to my discussion of fundamental versus technical analysis, you know, and I
Yeah.
always say fundamental analysis is what should be, technical analysis is what is. And, you know, in this case, it's looking at potential trends, and anything can be a trend: rising taxes, falling taxes, aging populations, AI, clean energy, whatever. So, in identifying investable asset classes within those trends, determining best in class securities products. So, even if we determine NVIDIA is the AI play, we still need to look at it from a technical standpoint and say, is this the right time to go
Yeah.
in there? You know, if it has a solid trend, fine. If it's falling, well, we're not going to buy something that's going down until it turns a corner.
Yeah, that gets into that idea of the sector analysis.
Right.
That NVIDIA is powerful not just because it's NVIDIA by itself, but because it's the best expression of the semiconductor dynamics right now. And so there are other companies in that orbit, and then finding out relative advantage at a moment is kind of key. And then under the identify potential trends, I would add, I think you got to have some kind of like classification of them, like, or assessment. It's not enough to say, well, that right there is a trend. The trend ultimately is very much like what's the name of that? What's the name of that ocean current comes out of the Gulf of Mexico?
The Gulf Stream.
Yeah. I mean, it's just a bunch of water, but it's moving in a certain way, driven by forces, and it has persistence, and it affects the environment around it, and the environment affects it, but it still is robust. Well, how much power and for what duration, over what span of time? So identifying the trend is to name it, but to understand the capacity for power, capacity for work. So power, what kind of power and persistence and resilience and robustness does it have? How much of that, like, why is that trend the one that we should concentrate on getting right? Because if there's 10 trends, which one do I prefer to be right about, or to get the best advantage of it? Why should I focus on this rather than that? I think it comes down to saying, well, trends that are connected to demographic waves of change are to be preferred, because there's exactly nothing can stop the progression of baby boomers expressing their values in the marketplace, you know. And there was, the fear the greatest generation that had grown up with the memory of the Depression and then World War II
Mhm.
created persistence in those trends. And so, it's the difference between a viral meme that has a shelf life. I think of it as like I'm always the comparison I was always using was the difference between the railroads in the 1880s and biotech findings. The railroad build out exploitation and retirement phase or steady state, took 100 years, 50 years to manifest and 100 years before it became a utility. So there was a 50-year window in which the full expression of the potential of that as the new thing that had the investable moment that dominated the market for a certain period until the efficiency of competition reduced it to the minimum viable competitive few, where it now becomes like in monopoly, it's essentially utilities. It's not going to have an explosive growth. Well, it took 50 years for whatever dollar value that represented. Like in 1700, there were no railroads, or maybe there were, but pretend at 1700 there was no railroads, and by 1950 the railroads had sort of reached terminal maintenance phase. So there's a 250-year window in which value was created, and so the volume of value that created over time was a certain volume. Well, a biotech innovation might have the same size, but within 3 years. You say the COVID vaccine, the mRNA vaccine, and all the money that's associated with that, bam, that whole thing, it arrives, it peaks, it diminishes into the sunset. Now that's a 3-year story. And so now the phases are the same, but the amplitude and frequency has changed, but the volume of money that's associated with that is different. So that's why I say identifying the potential trends also takes into account the other trends that are out there and the elasticity of the market, and is it expanding or contracting? Like all the trends starting in 1930, yeah, they were trends, but in a rapidly compressing market, there was no way to express that idea.
Right.
Until 1941. And now suddenly world conditions changed enough that created the next wave of great monopolies and industrial expansion. So somewhere around that potential trends, there's got to be some notion of the larger ecosystem and something about its dynamics. And
This could definitely have its
You know what I mean?
own slide, and
Yeah,
you
well,
gotta be thinking about a lot of
each one of
things there.
those has its own build out too. I mean,
Mhm.
if we rotated that, we'd see that's 4 icebergs,
Right.
and and um, and so the capstone. So to me, the capstone is trends, and underneath it is a set of verbs, the process that you go through to identify, describe, dimensionalize, assess, compare, look for synergies and leverage. All of those things kind of go into that.
Yeah. And a good example of showing how different trends could be would be to say nuclear power or nuclear fusion is
Yeah.
a potential trend, but that could take 10 years for acceptance and playing out. A shorter term trend might be acceptance that natural gas is a viable crossover energy. And right now nobody's interested in it, but it's investable if we start to get some buy signals on SSCs on weekly charts as an example. So drilling down a little bit further, this would be the step in between identifying investable products and actual trade entry, and these are just sample inputs. And I'm kind of a newsletter guy. I don't trade on that, but there's a few that have been pretty consistent for me through the years, and one of my core themes has been if I have something that a trend, let's say, that I'm looking at, and all of these have stock lists, um, and Investors Business Daily, Cabot, and Zacks kind of approach the market from slightly different angles. So if I find stock picks that are showing up on their buy lists of all three, it's usually a pretty powerful indicator. I still defer to the actual entry to have, some sort of a crossover or an SSC in this case, or a COTA 2 entry. But it's useful to have these as sorting mechanisms and saves me a hell of a lot of time to find ideas. They're doing good work, and it's been pretty reliable with numbers to prove it through the years.
Mhm.
And on the longer term, it's just bigger thinkers is this list. I used to maintain a list of 12 people that actually had Van on there. And I just threw a few names on here for illustrative purposes. One interesting thing I used to do when I had 10 or 12 that I monitored closely was I would keep a spreadsheet and rank whether they were bearish, bullish, or neutral. And if, let's say, they were 80% bullish, I would stay 80% invested. If they dropped to 50% bullish, I'd be 50% because I had to manage my business on a long only basis.
Yeah.
So that was sort of one of my sorting mechanisms there. So I did
Well,
have your
and that's reminiscent of the way I use the 10 broad indexes of the world market model on a performance basis to
Mhm.
reflect suitability for risk exposure for one more week.
Yeah. And taking it a step further, I could talk about cycles and all that good stuff, but it doesn't need to get too technical at this point. This is sort of broad strokes. And ultimately, this process did get me into NVIDIA at a split adjusted basis of about $5 and a bunch of other good names in the last few years. So it's been very good at picking for me, I guess is the way to
Yeah.
put that. All right, so I'm going to change gears completely here and switch over to a very short-term system that I use, and I've been trying to marry this to um, tortoise systems, and I'm avoiding the word scalping on this because it has been profitable for me. And in this case, at one point, I was trading Tesla using this process. Of late, it's been SMCI. And I had one really bad, ugly day that I whined to you about a couple of months ago on this one, where I think I lost 35,000 while I was getting a cup of coffee one morning. So live and learn. And just to run through this, putting some rules on my volatility system. Um, I really should start with the environment, only trade when directly monitoring and monitor my zero state or my state, make sure I'm in the proper frame of mind.
Yeah.
But the entry patterns are all the standard stuff, except that here I'm looking at OR 3, 5, 10, and 30 as 3 or 4 potential entries there. And this is truly a before 11 o'clock Eastern time trading system. So looking for the opening range patterns, SSCs, COTA 2 CDs, pinches, which is something that I never really trade, but um, I'm getting a little bit better at framing those up and saying, all right, what would I have done here? Um, and then just a powerful trend. I think you probably know the stat on that, Ken. How many days out of a week or a month does a stock actually trend all day long on average?
Yeah.
And there are those days, and the range stat on this thing right now has dropped from 95 to 78, but it's still a $78 move every day that's going on with this thing. Pretty crazy.
Yeah, I mean, that's a 1%. That's a
Yeah.
1% move. And so the $78 gets your attention, but normalized, the
Yeah, well,
1%.
it's a little closer to 8% actually on this. I think it's trading at 780 something right now.
Oh, oh, $78. Okay, yeah,
Yeah,
I was thinking 1%. Got an order of
yeah.
magnitude error on it.
So, the big picture on the entries, always looking at actually the whole list on the trade log that Phil and Griff have built is excellent for saying, well, have I considered everything that could happen today? But with respect to this stock, the key things that I look at is the range stat, the direction of the S&P, and the direction of Nvidia, because it tends to be highly correlated and they tend to lead each other, taking turns depending on what day of the week you're looking at it. Um, Sorry about all my typos in here. And then, of course, always looking at economic releases and other events, because um, since this is a $780 meme stock, as far as I'm concerned, it has an overreaction to news. So, it's better not to play with fire when the Fed is about to speak, unless you want to give it a little time to breathe. And that would take me back to an SSC or a Kata 2, because it's always going to overreact to news, and then that creates a tradable event. As long as you back off, let it play out a little bit, and then make your move. And Jay and I have had a lot of discussion about that with SPY, all the things that could go wrong in the next 5 months. The key is to be prepared to back off, let it play out, and then make your move.
Yeah, I
So
really think the idea of the seasonality of MACD Four Seasons is
okay,
where is as you start getting into the uh life cycle, the seasonal ebb and flow of that thing through time, you start getting a sense of when when it emerges out of the cave and starts growing, how long does that last and how far does it go? When it's in that steady state decay, how long does that last before it pinches or collapses, or that whole boom and bust cycle? To me, looking at the rate of change and the time series of the Four Seasons, and then trying to decide where you are in the psychology. To me, that represents the psychology of the stock and the various market participants.
yeah, and the
How
PSAR has been quite useful with this as well. Observing that when it flips, it usually stays there for 10 to 12 bars at a minimum. And, some days it's not like that. So those are the days not to trade, step away and do other things, or jump to different time frames and see if maybe a smaller position size on a longer time frame would be a better trade for the day. But this thing is so volatile that, in the morning, a lot of times the spread goes to $3 to $5. So I have to be careful with that. But putting an initial stop in at 5, which is less than 1% of price, has helped me out tremendously here. And then before 10:30, as soon as price moves $3 in my favor, I move it to a trailing $1.50 stop. And part of that is because Thinkorswim software just was blowing right through my limit orders for some reason, and I'm not about to argue with them, but I realize that if I put it in as a trailing stop, it usually honors my trade quite well. And then after 10:30, if volatilities drop down, really just as observed by the spread, if the spread is dropped to less than $1, then I go with a trailing 50-cent stop after the stock is $2 profitable. And then of course sniper exits if it's chopping sideways, and I don't see a really good super pinch trade there. It's just time to bail, and I would call that a time stop, I guess, would be the other way to look at that.
Yep.
And then done for the day at 11 with no more than 4 round trips. Beyond that, I feel like I'm rolling the dice, and I had days with 19 or 20 round trips on this stock that were profitable, but it was really draining my energy. So stepping back and looking for better setups was kind of a key there. One other thing I forgot to show you guys was based on this situation and these inputs. I did Apple trade the other day, bought some calls at 175, and on the daily chart was using the setup for that, and entered that at 1785 and got a really nice pop today. So I do like to say that my R on these kind of trades is 1,000, but it's not totally realistic because with options, you just never know what your fill is going to be on the way out. But that was my sort of mental stop, and have a pretty good trade on. And now looking back at these, it's going to trigger even some more buy orders based on what happened today. So, this trade could work a little while, and I have until March of next year to sit in this option trade. But I'll need to get with Jay on these Greeks and try to work some of that into it. But the key here was just a nice setup on Apple, and the tool was leaps or long dated calls to get into the position. And for now, it's serving me pretty well. And that's the end of my rambling for tonight. Questions on that one?
I think, where you end up getting into an actionable process, adopting the principles of lean thinking and the critical path through all the different factors of, on the simplest one is I get 12 different human advisors. What are the current market conditions that cause me to favor one or the other? What's the mechanism for putting the weights on the significant few rather than the wisdom of crowds? Like, is Ray Dalio the right guy to be following right now? How am I, what are their contributions to my predictions? Or is it really a comfort blanket to say, oh, well, I'm going to be philosophical about my conclusions because at least I talked to all the experts? Is that a rationalization, or is there an operational formula in there that demonstrates that it adds value? That's kind of always the bottom line on there. And so the approach that I've taken on this is really to go directly to relative price performance over measured time periods. And if I can, where I end up on this, just so you know my mind on this, is I just say, look, if the S&P, if I just accept the S&P, its performance over time, from between period 0 and time 1, if its performance is this, the beta, then, and the instrument I chose for whatever reason has this, my alpha is better. That really comes down to a comparison of slope. I just, what is the relative advantage of that guy over this one? And then you got to remember too, that if I'm just measuring from point to point, do I care if this one here, which is in second place, followed this path and this other one followed this path? So now in my mind, the straight line slope from point to point is the efficient line, but it may not be a correct representation of the path. Like I might prefer, like if there was something that was like this, and then another one that started off here and is now here, maybe I prefer B because of what he's done for me lately. So whenever, even as you make decisions about what time periods to measure on, that's kind of an arbitrary length too.
Mhm.
It can be. So I've adopted the philosophical principle of saying 30, time periods. Because I'm proposing to use stats, I just have said, well, I'm going to insist on 30 being the central point at which I may begin to make claims about the price move. And so I just picked 30. But then I also use 10 as the fast just to get the idea of what's the rate of change looking like in the last third. So I take the 30, each segment of 10, but I also care about the fast indicator and the slow indicator. And so I take a look at these things, to be honest, as really secondary sources where they are interpreting from a point of view about the basic price data. Price data behaves according to measurable statistics. And then each of these things, these people and these classification schemes, each one of those represents a lens that tries to make sense about when prices are in this condition, it leads to the next condition. So it's a prediction about what prices are doing. So I have moved away from sort of human estimates of future value, and I am simply basing my work on the physics of time and motion and physical forces. Because my personal opinion is that the impact on psychology, on human psychology, the forces of fear and greed, the forces of the unknown reactions to feelings of fear and greed are what causes these guys to be uncertain. Like they're judging the price action through their seasoned market sensory process. But the direct action of humans pushing buttons, fear and greed, is an elemental thing. It's a human nature thing, as opposed to a considerable wisdom thing. And I think in the short run, the shorter time frame that you're in, the more important the emotional response to market behavior. I think that's more important than the seasoned, mature judgment of these other guys. My personal opinion, because I'm trying to reduce the time frame between decisions to the smallest manageable level that I can sustain professionally, so that I don't have to rely on wisdom and interpretation. I can simply frame trades on direct observation of reward to risk under normal conditions, with 30 time periods being the definition of normal. Is the behavior, and then probably 180 days or 300 days being the standards that creates normal from abnormal and all that. Anyway, so replacing these other interpretive measures with statistical measures. So at some point you got to turn the crowd of advisors that you have, you got to make an action decision inside that circle. And so you've assembled a whole bunch of indicators and choir boys all commenting about this thing, and you still got to make a decision about how to frame it and what to do.
Right.
And so trying to find the operational term for it, minimum mission essential info. You can think of it as the critical path. You could say, if you followed the Pareto principle, you'd say, hey, 20% of these indicators are going to be responsible for 80% of your results. So which 20%? Are you going to tell me, oh, well, sometimes it's these guys and sometimes it's those guys, and depending on market conditions? Well, you haven't simplified that. Now you got to say, all right, what is the market condition indicator that tells me which 20% I should emphasize? That hasn't really simplified it much. So, but I think you got to go through all this to sort of map what are the triggers for your behaviors, and why are you choosing to trigger on that as opposed to knee-jerk response? Or am I consulting a large number of data sources for comfort or for insurance reasons or wisdom of crowds or consensus? At some point, the consensus is that. Buffett says,
Yep.
hey, 90% that and 10% cash for opportunities, which is trading and holding, trusting in the nature of the economic engines of growth, which is the human spirit, the strive to live and thrive, the biological necessity of the human species is reflected in the behavior of SPY over time. It's the human will to live and to optimize and to do our best and to keep trying. And so a 90-10 split, I see that as saying, okay, that's my trading. And because this can be so volatile and you got rapid turnover of inventory, 10% investment here could end up outproducing that in the short run. But now you got to worry about timing. When do I pull the trigger and convert cash to an asset? I got to go from cash to an asset for the growth explosion. And then at the peak, cash, put that back into cash. So I got to make that tango. I got to do that reliably in order to offset the ponderous inevitability of SPY. So each one of these guys that's all they're trying to do. That's all I'm trying to do. So
Yeah, one thing I could say about the short-term indicators, and you're kind of the outlier here, but I could say, the most important thing to you is the Z-score of the 30-period SMA or the 10-period EMA, and the most important
of
thing
the
is
RL,
Zacks
of the RL, I'd say.
yeah, of the RL. Okay. Zacks is earnings estimate revisions. Cabot is new highs and lows. Investors Business Daily is
Yeah.
standard chart patterns. And what I'm looking for is commonality between those to say everybody sees this or that lining up together.
Yeah.
And maybe a funnel would be a better analogy, where these guys are either out in the clouds above the funnel, and then this is the actual funnel, and at the bottom would be your specific entry points, SSC, kata
Yeah,
2, and
I
so on.
express that in the form of the compound critical state, where I try to say there's a 150-day look back, a 30-day look back, and a 10-day look back, each one representing a population that's demographically different, long-term buy and holders, swing traders, maybe day traders. And then when all three of these independent entities look at the current state as critical, where a big explosion in either direction is possible, suddenly you get the alignment of the planets. And when it does move, they're all surprised at the magnitude of the move. They thought it was going to be, in their mind, this is what I think happens. They think there's this normal state, and then a compound, or then a critical state for them is one that goes beyond that, this extra leg. It used to be just a 1% oscillation, and it's in a critical state. So if it goes 3%, they're not surprised. It was supposed to do that because there was a special condition. But I think what happens is when all three of those guys are independently in a critical state, now suddenly they all start reacting, and that thing goes 5 to 10%, and they're all surprised by the exceptional volatility. They were expecting volatility, and they got exceptional volatility. And that's where it goes. When they are surprised, they move from rational management to emotional reaction, either to preserve or to embrace. And they make an impulsive move because they are surprised. And the response to surprise is typically fight or flight. And it's an emotional, irrational decision. So in my view, that's how I express. Now, the point I'm trying to make is that's the way I operationalize the 2080 rule of how to pick moments when the consensus means something. And so it's nothing but a placeholder to create enough justification to act decisively and to not be surprised when others are surprised. In other words, how to start calibrating the size of the momentum that could happen. And I really just look at that as I'm in this compound critical state, and I know that this is the normal volatility, that's the surprising volatility, and I have no freaking idea how far that thing can go afterward. But I don't even care, because all I'm trying to do is get on board early and then ratchet my stop and just follow price until it decides when the run is done. And as long as I can preserve 2/3 or 3/4 of the total move, then I feel justified. I feel satisfied that I behave professionally and I can keep following that discipline. And it allows me to satisfy my primal human needs, but it also allows me to act decisively when surprise occurs with some justification that I'm acting in a way that is different than the herd mentality.
Yeah, and I think your most distinguishing characteristic is you're completely agnostic as to whether you're long or short. And that's
Yeah.
something that I've worked on as
Yeah.
long as I've known you. And I feel like I'm only halfway there for
Yeah,
that.
I'll tell you the single biggest thing that made the difference was, instead of looking at time like this with a long side bias or short side bias, it was rotating that thing 90 degrees and looking at it as a car driver with a couple lanes and then the shoulder of the road and then the fucking ditch. And so now this fucking truck is coming that way and I'm right here, I'm going to get volatility here. I don't care which way it goes.
Mm-hmm.
And I know that moves of this far are normal, and then the truck passes me, and then I can get back to the center of my lane easy. I might have to go onto the shoulder of the road, and then I'm nervous in the service. That's between Z1 and Z2. And then if it goes off the road, if I'm out here in the shoulder, I'm going to make a knee jerk and come back to the mean. But if I go this way, I got to jump the ditch and off we go, four-wheeling or something. And who knows? But what this allowed me to do was simply have a left or right orientation. And I'm just dodging traffic
I
or a
like that.
charging bull. Like, hey,
Yeah.
dude, what'll get you killed is freezing in front of the train. Don't stand on the train tracks. Or if you do, don't be surprised when you get hit by a train. The
Mhm.
outcome of that is predictable. And that way, what I'm not trying to do is decide which way the train is going to go. The train is just going to do this. What I'm trying to predict is how many people are jumping left or right. Hey, I just look at this and say, once the first couple guys start moving, there's a better than average chance the herd's going to follow them. Let's go. So I'm agnostic about which way is the herd going, left or right. Where I'd actually like to be as a carnivore is here's a train coming down the track. And there's this goddamn herd of cows right here. And I'm sitting here with my little pride of lions. And I say, look it, guys, we're just going to wait here. If we try to sneak up on these cows, they're going to detect us and run away. But the train is going to get their attention, and those things are going to be focused on the train and trying to get out of the way. And as soon as they feel safe, I'm ambushing them and smacking them. Like they're fixated on the train. I'm fixated on you just pick a direction and then I'm going to be the second mouse and I'm going to eat you while it's safe until the herd turns on me and stomps me to death. Not going to have that. So just pick off one or two on the edge. So that mentality, by the way, that simple shift in orientation, rotate 90 degrees, I can trace my willingness to go long or short without without. I'd rather go short than long, to be honest. I
Wow.
find it easier. It's easier.
Mhm.
And not because I want to go short and punish the longs or whatever. No, it's just easier. It's bigger moves faster. So frame of reference and the mental model that you use to interpret everything.
Yeah, who decided
everything.
that time always had to be on the x-axis in the first?
Time flows from left to right. We read from left to right.
I guess so.
When I do calendars, by the way, I hate regular calendars. I like going from 1 to 31. I like to see the whole month at a glance with line entries like that. I have a really hard time understanding time in monthly calendars. It's just hard for me. I have a hard time seeing it that way. I never organized my personal calendar on monthly calendars. It's always a list from 1 to 30, and I just highlight the weekends, in yellow, and I see it that way. I can see that at a glance. I cannot see monthly calendars correctly. It's an
Interesting.
act of will to read them that way. I don't know. Anyway, let's shift to Kevin. He's been abnormally patient. Well, he's patient for him, but he's abnormal for us.
I'm patient all the time. Just took just like 2 minutes ago, the neighbor fired up his lawnmower, and it sounds like he's
Oh,
cutting down trees. So, can you hear that in the back?
No, you have a good,
heard it all?
must have the Zoom filter is
I
clearing
got the
that
good
out.
ones, yeah. So
Yeah, yeah.
hopefully, and let me know if it's annoying.
I can't even hear.
So on those indicate, like I just relevant to my, I mean, um, part of my project has to be allocation among my portfolio. And the interesting, like I follow Rosenberg stuck out to me. I follow Rosenberg and I use his strategizer, and I use it because I have my Canadian. There's just things I invest in that I can't. They don't relate to the things that you teach or
Yeah.
they're commonly out there, especially in the Canadian market. It's just not that common. And so Strategizer, he does a good job of just outlaying for the next year. These are the top 4 sectors I would pick in Canada. So that's all I need. I got my list of stocks that I'll buy, and I'm holding them generally for dividends. And
Yeah.
then he's basically just saying I would rotate out of those and sectors into these 4 sectors, and I know what to do. I've got my picks inside of all those sectors. So I find there's some use for that because I can't process everything. Right. And I think I get where you're coming from there. And I really struggle to pick and not jump around.
Yeah.
You know, I mean, Rosenberg is Canadian, so that helps me out. He gives me content, right? Right now he says 0 in the US market.
Well, he's
But
been, well, if depending on when he started that position, he's had an opportunity to be wrong for
oh
5
yeah, he's
years
been
in a
wrong.
row.
Yeah, he's been wrong. And he said so too. I mean, he got caught off, and a lot of people got caught off by surprise.
Yeah.
But it's like, so because I'm kind of I look at it and say I have so much mental capital that I want to commit. And one of the questions I was gonna ask, I finished my SWOT and it brought out 4 or 5 different um things I need to work on for my projects. I'm building that out, and I think I was going to talk about that today, but maybe I'll do it next week, where I can outline them a little bit better. But one of the things on this trading, like when you're talking relevant to your conversation about general overall mapping, one
Yeah.
of the things that I'm struggling with is I have the long-term portfolio and trading. Let's like, so how do I determine, like, everyone putting out these are, I mean, here's a specific question. Everyone puts out an R. This is how much R they want to make, right? And I
Yeah.
think, okay, I get that. Uh, I understand that there's a limit to how much R I can generate in a day. So how big do I make R?
Yeah.
Because I say, well, I don't want to, like, basically, if I've worked it down, I don't want to work every day. I want to trade some days, many days, but not all the days. So if I set a specific dollar value and I said I want what R is required for an average trader, like I'm not I can only do what I can do. So what do I make R so that I could make $1,000 a day or 2,000 a day when I'm trading, right? Because there's a limit. Like we talked that one time about, I asked you, Ken, about that. How much money could I put in Mexico? Well, you could put 100 grand. I'm like, well, okay, that's $200 risk at an R10. So now what? If I make 2R on Mexico, I got $400 of income. So now what do I do?
Yeah.
Right? So
Yeah.
if I use too much capital, then I can't do my long-term investments. And if I have too much trading, then I have to rely solely on trading because my long-term investments aren't generating dividends. I've been successful in the past on dividend growth stocks, and I'm good at positional trading them. I'm good at it. It's not what I want to live off of, but it'll do me. So this kind of like, how do I figure out what is, like if I made R $5,000, I'd only have to make half an hour a day, right? Is it practical? I don't know. Like how do I work it out?
Yeah. Here's a way to think about it. And so this is what Luke is doing. So, there's sort of on the individual trade level. So if I normalize my procedure so that I can say that my average trade of that type has a histogram of something, a win. I like to think of it as the coin flip.
Right.
You know, it's it's 50-50 and pays 2-1. That's the one that I love. I'll take that one just forever and ever. Amen. If the trade is robust and reliable and every day I can get 10 trades a day that look like that, then the individual histogram looks like one thing. But when I start aggregating that into the day, that's where Luke's uh, net for a day of trading
Mhm.
is much better than this coin flip. His trade, he has like 70% winning days that pay 3-1. So what that allows you to do is not care so much about each individual trade, because you're getting the law of large numbers. Well, when you turn that into a standard week, it's even better than this. So there's the amount of dollars that you can put into an individual trade, but there's also we want to understand the R profile of this reliable system that says, look, if I'm getting enough trades every day or every week, but every day, and it stabilizes around here, and I have good risk management, so I'm not taking overnight risk. So I'm trading a liquid market, and I can trade it at size so that my actions don't distort what's going on. In other words, currency markets or trading the big fat indexes. If I could turn that into, say, look, I'm getting 100 R a week or 100 R a year, that works out to like 2 R a week. Then maybe if I'm getting 10 trades a day, and so I'm getting 50 trades a week that produces 2 R, hey, I really only need to get 0.04 R per trade net to get this. So the way I actually do it is I make the weekly R. I just move that to the left and say, I'm going to count 1/10 of an R as an R. So I really want to get 20 R so I can make 1,000 R a year. And that means I got to get 4 R a day. So let me cut that in half. Let me net 2 so I can get 10, so I can get 5. So once you get you would like the execution risk, if you could set that equal to 1 or to 0.5. It's easier math if you set it equal to 1. So if I could get 10 trades a day and I could net 2, then I could net 10 a week and I could get 1,000 a year, or no, or I'm sorry, 500. No, yeah, 10 a week. I could get how to get 10 a week times 50 weeks. So I'm getting 500.
Yep.
Yeah, 500 a year. Sorry. And so let's say I want to make 100,000 on that. $200.
200. Yeah.
So my risk per trade has to be $200. Now, that number has nothing to do with the deciding where to put your execution risk. Like I don't say, oh, well, if I want to have $200, then I'm gonna risk $1 per share. No, you have to go to the chart and say, based on the geometry of the chart, and I set that thing equal to whatever that is. That's the execution. And then that's my reward. And I have to have 2-to-1. I even say 3-to-1. So I can aim for 3, settle for 2, be happy with 1. Right.
Mhm.
And if I could get 10 trades a day and net 2, what's that mean? That means I probably had 4 scratches, 4 wins, and 2 losses of 1. That would net me 2 a day. Now, to trade 10 times a day, I either have to have one symbol that gives me 10 setups a day. Hard.
Yeah.
Unless you're trading on 3-minute charts with a robotic system that automates that's what Luke is moving towards. Or I'd rather see like 3. I'd like to have 10 symbols, of which 3 are popping, and I get an aggregate of 10 shots a day. And then I net 2R a day reliably. And that leads to at least 10 a week. Because there's going to be some days I get 4, and some days I only get 1. Some days I scratch. So if I can normalize around 2, I can normalize around 10 for the week. That means $200. Now, how much? Now there's a separate amount which says how much capital do I need to be able to take 10 trades a day, risking $200 and paying for the position? How much capital does that tie up? Even though I'm only risking $200, I still got to buy the position. So that moves you towards futures and options because of the efficiency of the capital. Instead of using $100,000 to buy those positions outright, I may be able, with a $10,000 account, to buy a couple contracts. And now I get a very efficient use of my capital. So efficient use of capital is one measure. Deciding what the dollar figure is that is significant for achieving the annual goal is significant. And I suggest it's around $200 if you can afford to set aside the capital, and which is no more than saying, look, if I was going to make a McDonald's franchise and I wanted to net $200 a day, and I was going to comfortably get $100,000 a year for the next 20 years, would it bother me? Would it bother me to invest $2 million in that? Whoops. Would it bother me to invest $2 million in the franchise? Well, if I invest $2 million in the franchise, that's a 5% return on invested capital. It's also inflation protected because it's going to scale. Right? Why couldn't I do that with a CD? Yeah, but that's sort of the cutoff line. It's some people will argue at you, hey, you should go the route of futures and currencies and options, because now instead of 2 million, you could put up 200,000 in order to make 100,000, and now you're making 50% return on capital. The argument against that is if you're not risk prudent, you can blow that up. Well, I'm trying to teach you systems that demonstrate if you just do the system, you are not going to blow up, because we are nowhere near putting the trading account at risk. Does that follow?
Yeah, I think, yeah. And I was having a conversation with my son today, and he asked why I don't look at more efficient uses, because it's this the you're caught in a battle. The more money I take out of uh, passive income generating,
Yeah.
as passive as dividends can be. Say in
Sure.
Canada, it's very beneficial tax wise to do
Sure.
dividends. So I'd say, well, okay, I've got lots of blue chips do well, and I can manage them. The more capital I have in them, the less I have to trade for a living,
Exactly.
right? So I can say I can afford to take risk, and I have my whole business life. I mean, I get what you're. All we did, manufacturers, we just spent money, made a little bit, ended up with a lot, right? You kind of like,
Yeah.
I'm working for future gains. I'm like a farmer, whatever else. I
Yeah.
just
So
spend
what
my
I
whole
want,
life
all I
paying for
want you to think
capital.
about is the Buffett model. Only now, instead of SPY, this is really your selected portfolio of dividends and, long-term appreciation.
Yeah,
And then the cash, with a small amount of that cash, because of the cycle time, you can actually outperform that with a small, but it's easier to do it because you realize you have the buffer and the safety of that long-term one to give you disinterestedness and relaxation. You're not
right.
you're not
Yeah, yeah,
grabbing the bat, you're not gripping the golf club too tight. But in
yeah.
terms of practical terms, so now the efficient use of this cash, when you start, if you have a system right now that scales to futures, options, and currencies, you've solved the problem of the misallocation of capital to risk $200 because you're not buying the outright positions. The point of trading the way we're trading with EWW is to get a feel for reliable volatility that is separate and distinct from when you're trading EWW every day. You know what you tune out? The fucking news about the market and
Yeah.
all of the predictions and all that shit, because you're trading a thing that is dramatically different, that behaves all in its own way. And so when you can trade EWW with those five patterns intraday, and you can produce trade histograms that are reliable, and then you say, what do my net days look like, and what do my week to weeks look like? Then you realize, oh, I can put those patterns on instruments that I can trade with futures and options and currencies. That's why you got to be watching what Brian Lancaster is doing with a couple
With his,
pairs,
yeah,
and look at
yeah.
what
I've been looking at some of those, and they look
yeah,
really good.
and
Yeah,
look at what Constantine is doing with just the gold US dollar, and Luke is doing with the DAX and a couple currency pairs. Those things trade 23 hours a day, so no overnight risk, with as much and with plenty of leverage, and it's scalable in fractional amounts, so you can let the market's money, you can let the machine earn the money that it uses to buy larger positions without additional risk to your capital. And then all you do is design this bastard so that that little engine is driving forward, and it's just throwing money off to this great big wagon, which is essentially your SPY and dividend achievers. And this thing gives you the growth engine, which is a tractor instead of some it's a diesel instead of some highly sensitive, finely tuned machine that requires a Formula One driver on his best day in good weather to compete against all the other guys. I ain't trying to do that at all. I'm trying to bring a pride of lions on a herd of dumb herbivores around a watering hole. I'm not trying to compete with other, the world-class best traders in the world in a trading competition with leverage. No, I'm trying to harvest the herbivores around the watering hole who are behaving like herd animals. That's all, in a risk managed way. So what you got to get comfortable is the shift in mindset away from all of the things that make sense in here and work on the things that allow you to every day, on any day, starting from scratch, walk in, frame it, and trade it with great confidence without having to have a warm up and a great big startup. It doesn't matter what the economic news are, or day of the week, or week of the month, or month of the year, or where we are in the macroeconomic cycle. Every trading day looks exactly like the other ones. Herd animals move towards a watering hole, and they get very quiet, and a crocodile scares them, and off they run, and then the lions pick them off as the herd separates. You know, when the herd is stampeding, you know what they're not doing? Is lining up together to stomp the shit out of a lion. It's every man for himself. So that's all we're trying to do. We're waiting for that surprise move to occur and then pick off the easy move and then pull it back to our lair and consume it.
So there's some, from that perspective, because I've been thinking in my, somehow, if I have the more, sorry, I got to go back to capital again because I don't understand how to use the other. I just, it's just something I got to have to research, right? But if I put more capital in something, I have to take less risk because I need less return out of it to make my living.
Yeah.
But
So
at the same time, I'm putting more at risk, right? So is
except
that
you're
where
not.
these?
Except you're not, because the amount of risk that you're taking is limited to the number of shares times the dollar per share that
Yeah,
you have
yeah,
at risk. So
yeah.
even though the cost,
But am I
like
better if I
the
better off
cost of
trying
the
to like
position? Yeah, go ahead.
if I try and make 2R on every trade, I'll have something to, like today, Mexico went up to 0.8 on a frog box. And I said, well, that's not good enough. So I let it come back down again. And I'm like,
Right.
well, what the,
Uh,
I got to the bottom. I'm like, dang, that 0.8 that's all I needed, right? If my capital was allocated right, I don't need to get 2R. I just need 0.8, 0.5, 0.4.
Here's
And
what you
those,
need.
I'm in
Yeah,
the
here's
middle of
what
it.
you need on every trade. Here's what you need on every trade. Once you internalize this, the scales are going to fall off your eyes. There is the risk side of the trade, and there is the reward side of the trade. On the risk side of the trade, you're just trying to say, look, I have an opportunity right here to make some amount of money that's significant compared to the amount of money that I know I'm not going to exceed in a loss. Like if I'm going to lose $100. No, if I'm going to lose $1, the reason I set that equal to $1 is because with this pattern, you know, here's the PSAR. And here's where the PSAR is going to flip and go. All right. So this amount of money on this pattern, the only thing that tells you is in this box, there's uncertainty. All right. I don't know what it's going to do. And then it moved enough to flip the PSAR. And I know this thing can go 3 times the size of this box. And that's not surprising. Okay. And I know that with just normal basic management, I can limit my loss to 1. And I have a reasonable opportunity to make 3. That's the only thing you got to have in your mind. So the risk simply says, how much of a reasonable upside do I have to justify putting the entry on having just come out of that region of uncertainty? Okay, 3-1. So once this thing starts moving up and it gets to that level and you feel confident in getting your stop to here, it does not matter. You should have no expectations about what this should give me. What should it give me, and how much is enough? I want you to hear how funny it sounds to say, how much is enough for me to care about it? How much free money do I have to give you before you take it seriously? All of it, any of it. Free money is free money. At any point on this curve, as it goes up, at any point on this curve, there is some adverse move whether it's here or here or here or here, there is some adverse move which is enough to satisfy me that I have seen the peak of that move time now. That was enough of a peak, and I am not going to give back more than that amount of money. There is some technical signal which tells me I've given it enough room for it to reasonably go as far to keep going, and it didn't. And then in your mind, you got to say, look, my trade-off decision is that, well, on this one, I made that much money. I gave back this much, but I kept that much. Hey, if that was just as easy as 1/3 and 2/3, you got to learn to be satisfied with that.
Yep.
That's all. And then all you do is you got some tote board over here that says, look, on iteration 1, I made $200. On iteration 2, I made $50 according to those rules. And this one I made 75. On this one, it was minus 20. And on this one, it was plus 20. And on this one, it was 400. Just keep totaling it up. And at the end of the day, what's my number? Whatever that number is, greater than 0,
It's a good day.
a good day. Well, I mean, what
Yeah.
the fuck? And no overnight risk. At no time in any of these moves did you ever risk more, let's just say, than $200 per trade. Hey, what if those were my numbers on 200? What if that was what I got? I got 4, 6, 7 and a quarter minus. I made $700 today. That turned out to be a 3.5 hour day.
Yeah.
So I've actually had 2 good days of the week. I've already got 1.5 in the bank. For tomorrow could be a 0.5, and I'm still on track. So as you're starting each week, you just say, look, I got to get to 10R. And here's 2, 4, 6, 8, 10. And then your actual, hey, here was 3.5, and here, as long as I'm north of that line, good week. So you set this at some lower, I would take it like the average -1 standard deviation. Let that be the lower limit of what you need to get each week. And then if you had even kind of a below average week, you could still be above that line. And anything north of that line is still better. And then as long as you're trading at a size that you feel comfortable, every time that engine throws off excessive gains, you're just throwing it back into the wagon, which is being managed with absolute, unconsciousness, which will beat 85% of active managers every year. That you can't lose with that.
Yeah. So
my
and I
point
think,
is, yeah, you cannot have You gotta remember that from the time this thing starts, there is some level at which it's gonna fail that's not knowable to you. You can estimate it on the basis of 3 to 1 historically, but we don't know. We cannot know whether this is going to stop here or here or here or be the one that blows all the way through. The longer you wait to get in, the smaller amount that you can get once it finally reveals. And there's nothing about how far it goes up or how fast which tells you any information about where it's going to stop. You have to have the discipline to say, that is the exit rule that gets me out, no matter what I thought. That's why you got to leave that to the assistant manager who's going to follow your rules. That's all. Once you get those patterns, once you adopt that mindset and get these patterns down, you'll get to look at all of these things as a science project. And the most important moment is when you go from initial risk to capital to no risk to my capital. And I'm going to make $100. It's free money after that. It's just a science project. And you are free to just let the exit rule be the exit rule. And then when you have enough stats, you can decide, do I want to adjust the standard rule for my assistant manager, who's going to run that thing without you having to commit emotionally to it. The next step on that is to automate it with a robot,
Yeah.
or to hire a guy to trade it like Luke and give him a chunk of money and say, manage his fucking money. Pardon my language. Or whatever
So
you want to
I
do
think,
for implementation.
yeah, no, and I sorry, engineer, thinker.
Yeah.
I look at the world of possibilities. So that's great. And I think in this case, you know what, the funny part about the whole, like, I've been doing really well, and then Friday, I was like, I got to let things run longer, and I sucked on Friday, and then I kind of biffed yesterday, and I'm just like, what am I trying to do? Because all the positions I lost in, they were profitable,
Right.
and then I
Every
let
single
them
one of
go
them.
down. Every one
Every
of them
single
was,
one of
and then I
them.
let them go down. But I
Yeah.
have a drive to say, look, if I want to make an
Right.
income, I got to make a significant amount of R to make my income. So I have to let them run, and I'll say, well, so there's this, the thing I'm learning, sorry, in the way I'm operating, is to try and drive more R. And you're is it, I should be saying, how much money can I put in the wagon, not how much R I'm
Also,
generating
so
to
there's
make
two ways.
myself
So
feel
there's
good.
2 ways to do that, right? One of them is, well, first of all, you never change the geometry
Yeah, no,
of the winning
yeah,
trade. Never
yeah,
change the geometry. And the geometry is this: PSAR goes down, PSAR flips, you get to no lose plus dinner for 2. It
yeah.
moves back to the skin of the dragon, you exit. That's all you do. How do you get more money? You increase the dollars per trade, which gives you more shares, but with exactly the same geometry. So then you can say, what is the upper limit of shares that I can buy in that instrument before I start getting trouble filling the order? Good problem to have. So that's why
Mhm.
you want to gravitate towards large caps and indexes. Or, so you increase the dollars per trade, or you increase the number of simultaneous positions or near simultaneous positions. So I'm trading not just EWW, but EWZ and DIA and XLI and E and F, because they are moving out of phase with each other, and I only have to
Mhm.
make a decision on one of them. And so the little herd, so now, like the little sheepdog is moving the herd towards the pen. He can do that. His span of control, whereas we talked about this on Saturday, a cat can kill one thing and eat it. A dog can move a herd to its destination. Span of control is why dogs and men beat cats. That's why we're at the top of the food chain, and we protect tigers. So you can either increase the dollars at risk per individual trade, can always do that. You can increase the number of symbols in order to increase the number of trades per day. But, you know, if you've got the trading day that looks like this and you have some little window in here where it's optimized and then nothing at lunch and then one short little thing in here, guys will try to overtrade and say, well, let me go earlier to get more trades, and let me trade through lunch to get more trades, and let me trade closer to the end to get more trades. But those aren't the same setups. You're changing the geometry. But I can only trade EWW once or twice in here and only once in here. So I'm only getting 3 trades a day. So now I got to have $1,000 of risk and 10,000 shares. Now I'm getting nervous about that. Okay, that's an emotional response. And maybe it's a practical response to risk. So what I got to do is I got to get more symbols so I can spread the risk over 5 or 6 things in the herd and then move the herd towards the destination. That's how you increase the net real dollars returned each day. Don't ever change the geometry. If I did 1,000 trades or you did 1,000 trades and you prove to yourself that PSAR goes down, PSAR flips, I take the trade, I exit at the skin of the dragon, and that worked on 1,000 trades, and you got a histogram that you love, don't suddenly try to, well, I'm going to make the risk box half as small so I can double the position size. You just change the geometry. Keep the geometry the same and buy more machines. I got one monkey that can bend the pipe 50 times a minute or 50 times an hour. I need 100. Okay, get a second machine. You know, just start adding symbols. Well, now the cost of capital, the cost of buying the full position with stocks is too much. That's why you got to go to efficiency towards futures, options, currencies. So now I can start getting efficient use of capital to buy the position. I'm not increasing the risk per trade. I'm just more efficient with the capital. Like on DIA, if I've got 50 cents is the R10, I got to buy a $350 stock. And then if I'm going to, if it's 50 cents is the risk and I got to make $1. So I'm going to buy 200 shares at $350. All right. I just got $70,000 in that position times 10 during the day. So I got to have $500,000. Or if I buy one mini contract, the movement of 1 cent equals $5. So to make $200, it's got to move 40 cents on one contract. With an account of $5,000 in my futures account, I have enough leverage to afford 10 contracts during the day. On a single contract, on a movement of 40 cents, I can make my $200 per trade. Done. Done in one. Why do I have you practicing trading on DIA? For that very reason, that the YM contract, the movement of 1 penny represents $5. In the NZ contract, the movement of 1 penny is $10. And in the NS.
Hey, can I ask you, hey, Ken, this is Jay. I
Yeah,
just got back. Hey,
Yeah.
Just a quick question, Kevin. Like, throw out, like, tell me a dollar figure you're trying to make per month. I mean, obviously,
Well,
100 grand would be great, but right? But a dollar figure, tell me how much it is. What's going to make you happy?
Well, it depends. Like, again, goes back to the capitalist. I can basically live off dividends, right? So I don't want to do that, and that's a difficulty from
Okay, answer the question he asked you, which is on a pilot program,
Yeah.
which represents 1/20th of what you really want. If you just said 100 grand, do the math on that one, Jay.
But if you want to, like, let's say, like, let's say, hey, I'm happy if I can make $15,000 a month. Do you want more or less than that?
no, that's good. That's US dollar. That's sufficient. Yep.
15 grand. Okay. I mean, I can show you how to do that in my sleep with options. No problem. For sure. But it's just you know, uh selling options, buying options, that's it. I mean, does anyone here, like, do you know what a box trade is? An SPX box trade?
I have very little. Like, I've done a little bit of investigation into it, but
Okay.
I haven't. I
That's
have
fine.
very little knowledge. Yeah.
Yeah. So I mean, I think, and I have, today was my son's birthday, so we had a birthday dinner. But maybe with Ken's permission, like maybe next week or the week after, I'd love to show what a box trade is and how they work, and I'll show you some volume behind them. But they make, like, right now they're paying like 5.6%. Okay, so you can do these, and it doesn't sound like a lot of money, but it's not a hit on your margin. So, like, in my case, it's paying a material amount of money every single month with zero risk, and then I can try to implement what I'm learning here, which I've done for the last couple of days, which has been great. And my goal is very small. I'm only trying to make like 2,000 to 2,500 a day, which doesn't sound like a lot of money, but 2,500 a day is like 60 grand a month. That's a lot
That's a
for a
lot. Yeah.
redneck from Alabama. Are you kidding me? You know?
Yeah.
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 And
So
Well, there's
it's
that. The whole
move,
the whole
yeah, let
question
me,
is
I gotta,
Yeah.
I'm 10 minutes late for tonight's podcast. So
Podcast,
let me
yeah.
just summarize by saying the techniques that I'm showing you in DIA and EWW and the big fat indexes are all about framing for routine directional moves intraday in indices.
which are
In the
phenomenal, by the way.
in the most conservative index, the biggest fattest index in the world is DIA, and it moves reliably $5 a day.
For sure.
And then on a single E-mini contract, that is a move in one contract of $2,500. So if you could be 8% efficient, taking 1/12 of a bite out of that, you'll make your $200 a day times 200 trading days a year is 40K. So 100K is easily within reach. 200K is this one, which is 15K a month net. And that's not even touching options, which adds extra juice and gravy to this thing. But what it comes down to is having a mathematical basis in how this thing moves reliably intraday. And when are the critical states in which these bigger, easier moves are most likely to occur? When these work, they work right away. And so you get your nut right away. The herd is around the watering hole and gets spooked, and off they go. There's no more herd defense, and you can pick off the easy move to meet your needs, to feed your tribe. That is the essential idea. Like, you just need to make the kill and kill it. Not how many could I have killed and how many more do I want to have killed. No. You got to shift that altogether away from, you can only grab as much as you can carry anyway. When you got your hands full, you're good. All right. That's everything I wanted to say. I want to get this produced, and I got to get to the to the nightly
Thanks, Ken.
podcast here shortly. So,
Thanks, guys. Seen a few.
Lots to learn.
yep, we're getting there. It's mostly between our ears.
All right. Thanks. Yeah.